Well, an old market adage says that a rising tide lifts all boats. Well, except when it doesn't. In this morning's U.S. Bank Economic 360, we look at the fourth quarter market rally, which has been great for a few stocks, but not so great for many others. U.S. Bank Vice President and Senior Portfolio Manager Mike Denneman joins Business Courier editor Rob Dahlmeyer in the studio to talk about why. Mike and Rob.
So there is good news and bad news,
right.
But let's start with the good news.
Sure, always the best place to start.
I think so.
Right. So only a few trading days left in the year, and frankly there hasn't been a lot of good news for the market in 2015. It hasn't been a terrible year, but not a very impressive one either. Now, things looked quite a bit different, though, as we were finishing the third quarter. The market had a correction in August, lost 10%. September was no better. So as we were starting the fourth quarter, things looked a lot more tenuous than they do today. So that's the good news. The market didn't totally unravel. We didn't see it turn into a bear market. So yeah, the good news is that, even though it's not been an impressive year for the market as a whole, 3 months ago it looked a whole lot worse.
Yeah. So what is the bad news then?
Yeah, there's always the flip side of the coin, right? So, as Peg said, usually when the market has a rally, and a very impressive rally in the fourth quarter, the market's going to take most stocks upward with it. Unfortunately, that's not really what we've seen over the last few months. It's what's called a very narrow market, and by that we mean there are a handful of stocks that are doing extremely well, and then a bunch of others that are doing, not so much. So, when we take a look at what's gone on in the fourth quarter, we've had a very few haves and a whole lot more have-nots. In fact, some Wall Street analysts have gone as far as to narrow it down to 10 key stocks that really have driven the S&P 500. So if you've got a diversified portfolio, you're going to have a lot more of those 490 other stocks than you are in that 10. And in fact, that group of 10, you'll notice a theme. In there you've got Amazon, Google, Microsoft, Facebook, Apple. So, you notice a theme there?
Right.
Yeah. So, a lot of a subset of tech has become pretty much high flyers. No one's willing to say quite yet that that's another tech bubble, but there are some that are hinting at it.
So what does this tell us heading into next year?
Sure. So, well, we can't draw parallels between the two groups. That's the silver lining.
Right.
The market in general doesn't look anywhere near so-called bubble territory. The market as a whole looks very reasonably valued, maybe a little bit on the higher side of average, but certainly not wildly overpriced. The typical stock out there is going to be pretty reasonably valued, not again trading at too high a level. So that's reassuring for the market as a whole. Again, when we look at that small subset, though, that's a little bit of a different story. And one wonders, could that extraordinary performance we've seen recently, can that continue? And so that remains to be seen. But I think the bottom line for investors is there's nothing particularly scary about the market right now in a general sense. But if you are going to buy stocks, just be careful that you're not paying too much.
And that's, well, you just talk about paying too much, and thanks for this, but you talk about Google, Apple, etc. They are priced at such a premium right now
very high.
That it can get a bit scary there.
It takes you back to the late 90s.
Absolutely. Well, thanks very much.